What's going on with Bitcoin?
Yeah, so Bitcoin's been dancing right around that 20,000 level. And the reason why I was harping on 20,000 is because that happened to be the high from the last bull cycle. So in 2017, we saw this unbelievable percentage move to 20,000, and then the bear market started. Finally, we got into the next bull market. And then basically when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it, right? So in every past bear market cycle, the Fed's been printing money with QE and QE1, QE2, and all those. And this is this first cycle, it isn't printing money. And that makes me wonder if at least we go down 80 to 85%, which gives me that 12 to 13,000 target, or could we actually go even a little bit lower? So I think that we're still going to see another leg down, minimum 12 to 13,000, and then I'll have to reevaluate if it's going to go lower after that.
From what I'm understanding, it's going to really reduce the amount of energy that the system needs, which sounds to me good, but I'm guessing that there is more to it than that. So what are your thoughts?
Yeah, so I think that is a very important aspect about reducing energy, because I know that a lot of fund managers and investment portfolio managers, one of the things that they're always pressured on is being very environmentally conscious, right? So that's going to alleviate that issue. And then also the merge is going to change the way the mining is done, which almost creates it as a deflationary asset, almost like kind of a Bitcoin. So I actually think longer term, this is really bullish for Ethereum. And I do think that it makes it much more attractive to investors overall, not just for the utility purposes, but also for the savings and kind of a different way to invest versus holding US dollars and other currencies, fiat currencies. So I think that's very good. I think the biggest thing next week with the merge is it has to go smoothly, right? So, and this is big for the entire crypto market. Everyone's looking to that. They need to nail it to give the confidence to the crypto markets. If they do, I think you could get a little short-term upside, kind of the relief of, okay, it happened, it went smoothly. It doesn't change the fact that I think eventually Bitcoin's going to 12, 13,000, but in the near term, it should be a positive.
I believe coming up next week, we will get the latest CPI data, which will cover August. I wanted to ask you about that. What do you see coming? But in addition to what you see coming, what are the points that you look for when that type of report comes out?
So definitely we're looking at that headline and core number on the CPI data. So the consumer price index, which basically is what the market's paying attention to so closely, because it's what the Federal Reserve will likely gauge their next rate decision on, right? So if you still see very high inflation and it's not coming down, it's likely going to signal the Fed has to do 75 basis points at the next meeting. My guess is, considering, you look at oil, and oil has collapsed into the mid 80 range or so. We've seen copper, we've seen nickel, all of these commodities have come down so sharply. It should be trickling through to the consumer price index, which means inflation should show that it is kind of fading a little bit. Now, I think the kicker is going to be this, is that I don't think we're going back to that 2% or under that the Fed really wants us to get to for years. And I think that's going to be a big issue down the line, as they're not going to be able to stimulate if we go into a recession. So if you think about it, every recession we've had for the last 20 years, basically, the Fed has stimulated in some way, whether it's printing of money or dropping interest rates or buying bonds to have on their balance sheet. They've been doing massive stimulus. That was all with 2% or less inflation. The fact is, we're at a point where unless they get that below 2%, they can't print money again to save us from the next recession. And that's the boogeyman to me. That's the real scary thing. If this economy goes into recession, how do we get out without the Fed's help?
Right. And when we talk about inflation, I believe you said before you see it getting sticky at that 4 to 5% level. Is that still what you're thinking there?
Yeah, I'm kind of right in that 4%-ish area, give or take a little bit. And I think that's going to be elevated enough that it's going to make it very hard for the Fed to stimulate in the next recession. And that's again, really a tricky scenario, because I feel like the markets are so conditioned to say, oh, well, if we go into a recession, no big deal. The Fed will print some money and we'll get out of it in 6 months or whatever it may be. But they can't do that, because what'll happen is you'll see inflation surge back, this time maybe higher than 10%, maybe 15%. And again, that's going to keep them on the sidelines. And the market's like a child that kind of doesn't have their parents standing by to protect them anymore. The market is going to have to figure it out on its own, and it probably won't be super fun.
So over the summer, where were you seeing opportunity? Where were you trading?
Wow. So, I mean, with the volatility in the stock market, there's been some great plays. The markets had gotten crushed from June through July into early August. Then we saw the stock market stage a massive rally up, then a big fall just in the last couple of weeks before this latest bounce. So I would say in stocks, it's been tremendously good in terms of swing trading and day trading and kind of positioning yourself. And then I also think, gold is starting to look very interesting down here. It's looking like it's trying to hold support. And I think the biggest thing out there that investors should be paying attention to is the dollar and then the 10-year yield. And those both have been on a tear lately, although it does look like the dollar may have topped. So short term, we probably have a near-term top in the dollar. It doesn't necessarily mean we can't go higher in a few months, but there were some key things that actually happened here. And I'm going to bring up and I'm going to show this chart for you guys. Let me just bring up my charts here and I'll show you guys what we have going on. But if we look at the US dollar, the USD JPY, which is the dollar yen, I want to show you this. So this is a line that I was following recently, and you saw the yen was just getting crushed against the dollar more and more. But look at the trend line that we just hit a couple days ago. And that to me was a signal that the dollar may start to weaken. And sure enough, we've started to see that. We should see a continued pullback on the dollar yen all the way back to at least 139. So there should be some more downside. That does imply that the dollar, the DXY, should also stay weaker in the near term. But that was a big one for me. Like so much of this market has been driven by the strength in the dollar. And what I mean by that is, as the dollar was going higher, stocks and risk assets were getting crushed. We even saw gold getting crushed, right? So the fact that the dollar near term has topped, it should give the stock market, crypto, a little bit of a reprieve to maybe have a small bounce higher.
You mentioned the possibility of 75 basis points. We did have Powell with very hawkish comments earlier this week. So what's your view on that?
Yeah, so I found that so fascinating, right? And so let's rewind even more to Jackson Hole. So Jackson Hole, he came out extremely hawkish, like the most hawkish I think we'd ever heard him speak. And the markets freaked out, and we saw a big sell-off that day, and really the following 1 week period was a massive sell-off in the stock market. But if you look at the underlying factors, the market, the bond market, which is actually the smarter of markets, it's the market that has more money, it has more big money. So people think about it as being the smarter of the markets when you compare the stock market to the bond market. The bond market did not believe him, right? So let me bring up this chart, and I think this is such a cool chart to show. So we're going to look at the 10-year yield chart. So the 10-year yield, which is interest rates. And if you look at, this is the daily chart. And over here, this was in June. So in June, the 10-year yield was at 3.5%. When the comments for Jackson Hole came out, we were at 3.1, and we've only gone back to 3.3, even with the most hawkish comments the Fed has ever put out on hiking rates and being just hard against inflation. And what that tells me is that they believed that rates were going to go higher back here than over here. And so basically the bond market is calling the bluff from Jerome Powell and saying, you know what? We think you're talking a tough game, but we think that when the economy starts to weaken, you're going to back off really quickly, and we're not going to see rates as high as what the stock market is thinking in this situation. And I think you could almost confirm that with the DXY, right? So yesterday, or in the last couple of days, we had those comments from Jerome Powell again. He reiterated his hawkishness. And what happens to the dollar? Instead of rallying higher, it actually fell. And so again, now the currency markets are starting to doubt Jerome Powell. So I'm in the camp that I think It all depends on the CPI data next week, whether it's 50 or 75. But I do think if the inflation comes down decently, we might only see 50 basis points in the September meeting. If I had to choose, was there it's a 75 or a 50, I'm going with 50 right now, not only because I think the CPI number is going to come down a little bit and make it more comfortable for the Fed to do 50, but also because they're reducing their balance sheet, which when they reduce their balance sheet, it also works as a tightening measure. So it's almost like they would almost equal 75 basis points by doing 50 basis points and also reducing their balance sheet at the same time. And I think the Fed has to be so careful. Like this is, and again, he has to talk a hawkish game. I understand Jerome Powell, but they have to be so careful that they don't overdo it and push us into a bad recession, because it's not like 5 years ago or 2 years ago or 6 years ago where they can print us out. They can't. And so if they really trigger a bad recession, the economy is going to be stuck in that recession until it figures its own way out. And that, I hope the Federal Reserve is very aware of that.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.